Alright, so this is section 3M of the swing trading course. And again, this is the old course. I'm not using the new course. That's all you need. Alright, so judging the market by its own action. It's just background about the business. Um, Nothing here. Just talks about the business of Wall Street, the financing, etc. Alright. Tape reading and chart reading. Tape reading and chart reading enable one to detect and profit by these inside operations or manipulation to judge the future course of stocks. Basically, you got to be able to identify accumulation, markup, distribution, markdown, their campaign. Okay. Anyway, by weighing the relation of supply to demand, this sometimes can be done from price alone, but if you consider also the volume of the transaction, you gain an additional and vitally important helpful factor. It's very important to use the volume. Um, Later on, you'll see why. By accurately judging supply and demand, you'll be able to decide the trend of the whole market and of certain stocks, and which stocks to buy or sell, and what's more important, when to do so. This is a timing thing. You want to be able to time it. You always aim to select the most promising opportunities, that is, the stocks which are likely to move the soonest, fastest, furthest. Furthest is done by looking at the base. It could be even the consolidation or on a pullback. The pullback, the length of the minor base, like right after a rally, the pullback. Uh, the soonest, the fastest, the furthest. You make no commitments without sound reasons, and you avoid undue risk. Whenever you study the tape or a chart, consider what you see there as an expression of the forces that lift and depress prices. So whenever you're looking at a chart, you're trying to gauge pressure, okay? Buying and selling pressure. Whenever you look at a chart, you're trying to gauge buying and selling pressure, not candles, not formations, like those technical analysis formations. You're not trying to do any of that. What you're trying to do is you're trying to view it from the perspective of supply and demand, meaning pressure and support, meaning buying and selling pressure, and not from the perspective of drawing all these lines all over the place and looking for formations and wedges and triangles and all of that. Now, this is very important right here. Whenever you judge the tape or a chart, whenever you study the tape or a chart, consider what you see there as an expression of the forces that lift and depress prices. Basically, pressure, buying and selling pressure. Study your charts not with an eye to comparing the shapes or the formations, meaning don't compare the shapes and formations, but from the viewpoint of the behavior and the motives. Okay? Motives behind the behavior and the success and failures of the buyers and sellers as they struggle for mastery over every move. When you're looking at a chart, you are trying to understand the behavior on the chart by having the point of view of support and pressure. Basically, pressure, buying and selling pressure. You're trying to judge which side has more and less pressure. You're trying to judge at another higher level what are the motives behind the move down or the move up. Is it real? Is it a false move? Is it a shakeout? Is it a stop run? So that's the behavior and motive part. And then what you want to see is success and failures. Okay, try to go up once, didn't go through. Try to go up again, didn't go through. Try to go up 3 times, still didn't go through. That's failure. Even the second time, meaning the test, like you have a climax secondary test, being able to see if it's able to continue down or continue up after climax, the secondary tests, or on the pullback, if, the first pullback, what about the test right after, like the secondary test and a pullback, you're trying to view whether it's able to go down or not, and whether it tracks the following in terms of volume or not. Anyway, the struggle is continuous. The tape shows all in the detail, shows all this in detail. The charts enable you to pick the market apart and study whatever portion of phase in it you choose. Supply and demand may be studied from the tape as stock ticker, and even better by advantages from charts. You can study supply and demands from the tape and from charts. See? What that means is you can apply tape reading skills, principles on charts. You don't necessarily need a time and sales tape. Tape is a moving picture. Prices are constantly showing strength or weakness. Strength where the buyers are dominant, and weakness when the offerings overpower the buyers. All the various phases of dull activity, strength or weakness, from depression to boom. All these are fully recorded on tape. All he's saying is just look at the chart, but from the perspective of pressure, from buying and selling pressure. And now that you are undertaking this method, it is best that you prepare your mind for it by discarding other methods. So if you're using other methods, there are plenty of other methods. Elliott wave. Elliott wave. There's momentum based. There's numerous other methods. A lot of folks will be stuck on that RSI. It's not going to work. Why? Because you have too many criteria in your head for a good and a bad stock. Alright, so they're going to conflict in the mind, and they will distort the judgment because there are multiple criteria from competing methodologies. They will not work. Fundamental right here will not work. This includes news fundamental analysis, statistics. Statistics are like economic statistics, so or just there's a lot of statistics, but there's certain types of statistics that you are supposed to use, which I'll go into in a future video. Like, for example, one of the things that Wyckoff did was he did use statistics. He did. What he did was, when he was looking at which stock to trade intraday, he would see the number of rotations in different stocks. So you have a list of 5 stocks. He would see on average the number of rotations in each of these stocks, and the length of the move, the length of that rotation. So he did measure that statistically. He didn't just go in it. He also looked at the daily range. So daily range, number of rotations, the length of that rotations. This was all tabulated. And I guess maybe I can show that. Let's see. This is one example right here. Below is a tabulation of the average daily range of 5 leading active stocks. So this is the range. This is tabulation of what these different stocks did in the month. Why? Because you need big range. Let's see, I'll find another example here. The number of swings, rotations, basically from 1 to 10 points. You see? This stock at that time, Auburn, has 169, where it was one swing that had 1 to 10 right here, that's the number of swings, and this is the total number of swings. So how many of these swings from 1 to 10 consecutive points are without a 1 point reversal, meaning, shit, what did I do? Without a 1 point reversal. So how many of them like continue? Obviously you have here a lot of 1 point swings, and not, and in some cases you have like, like a market that keeps on going. It's a runaway market. So in this case, Auburn had a, 4 times it had swings of 10 points without a reversal. That's what this is saying. So, and this is important because you want a rotational market, especially if you're buying pullbacks. You want a market that rally, pull back to 50%, for example, retracement, then rally, then pull back 50%, then rally, then pull back 50%. It makes trading easy. But if you have a market that's run away, like, you'll have to buy the breakout. So anyway, I'm not going to go into all that. But the point here is these are statistics. So if someone says you don't use statistics, like, just, this is his work. These are all statistics. See, here's a tabulation, etc. Anyway, so this statistics is different than the statistics that he's talking about here. Fundamental statistics is taking a look at the earnings, or basically the information that's published, and trying to trade off of it. So earnings, all of that stuff, PE ratios, etc. Those are different. Okay, so anyway, it is not necessary for you to consider any of these factors, because the effect of all of them is boiled down to you on the tape. So all earnings, or PE, or it has great whatever, new product lines, guidance, all of that, already it's like it immediately has an impact on the tape. So if it's meaningful information that comes out, it will result in a meaningful price movement and volume. So why not just look at the effect of all of these items by looking at what it does to the price. It concentrates all these elements into combined effect. You see, the combined effect of all of that. You draw from the tape or from your charts the comparative few facts which you require for your purpose. These facts are price, volume, or intensity of trading, or force, or whatever you want to call it, intensity of trading, and 3, the relationship between price movement and volume. Okay, so that's what is meant by the relationship between price and volume is the amount of price change relative to the amount of volume. How much price has changed relative to the amount of volume, and you take that and you compare it with prior upswings and downswings. What else? The time required for all the movements is just the time or the length of the rally. Did it last on an intraday basis? It would be like, did it last an hour, 45 minutes, 30 minutes, 20 minutes? On daily, it could be, did it last a week? Basically the number of bars if you're using a time frame. You're thus better equipped than a man who is supplied with all the financial news. Why? Because all of it is already boiled down to the tape, which is what you're looking at, via the chart. The chart is a graphical representation of the tape. You never need to read anything or financial or all this. You can absolutely ignore all the thousands of tips, rumors, reports. You can disregard all and complete. And finally, unless you do this, you will not be able to get the results you want. Okay, there's a lot of truth to that, but also, you know, if you're trading for short-term operations, you want to be aware of of um, of news. So when he's writing this, he's saying that look at the tape, but I mean, that's fine. But short-term operations, you really need to know. You need to know if the crude inventory report is coming out. You need to know if the WASD report is coming out. You need to know if the FOMC is coming out, because it will have an impact, especially much more on the short term. On short term trading, it will have an impact on it. So, although I don't 100% agree with him, but I think the point that he's trying to make here is focus on the chart, judge the chart, judge the reality that is in front of you, and if there's any information out, traders who are in the know will get to know it first and they will react, and it will impact the chart even before that information is available to the public. So that's the point. But at the same time, for intraday operations, you have to be very careful, um, because if you have an inventory report, or especially WASD, what will happen is, for example, let's say you're in the soybean market and that fucking report comes out. What'll happen is it can jump beyond your stop. Like, your stop will not get hit if you're in that market, and it'll just jump right over it. And that has happened. So you have to um, you have to at least understand the calendar. And there are other times when there is fundamental news coming out. Let's say in gold, not gold, but FOMC. Before FOMC, a few days, 1 to 2 days before FOMC, or even the day or night before FOMC, there's what happens is there's accumulation or distribution that happens on a short-term basis, where they're building a base and they're preparing for FOMC, and you can see that. Um, if you take a look at FOMC and take a look at gold, and you see the preparation for the move, you'll see like 1 day or 2 day before or something like that. So it it is important to know the economic calendar, because it will definitely have an impact on short term moves, uh, and on larger term also. Like, so, but the focus of that point is really, don't use all these different methods. Just use the Wyckoff method. And I would say it's important to know what's on the chart, on the eco calendar, especially if you're trading intraday. Anyway, forms of charts. I'm not sure if I'm gonna go through this. I'm gonna use this shit. This is, I think, I'll save for tomorrow. But anyway, I'm not gonna go through this. Like, it's very apparent what kind of charts you need. It's a bar chart, a wave chart, and a PNF chart. You need that for your stock, and you need it for the market. So I'll go through some of this, just so we're all on the same page, and do that next time. Vertical charts, by the way, are bar charts, so don't get confused. Bar charts and candle charts, to me, they look the same. I don't see the difference. One has a fat body and the other one doesn't. It's the same data, open, high, low, close. So I don't see anything wrong with using a candle versus a bar chart. It's the same data points. you know. And one other point I want to mention, this one right here is really important, and this will deal with a lot of questions. Most of the popular prejudice against charts undoubtedly due to the fact that many people mistakenly attempt to use charts mechanically, okay, without judgment. They endeavor to draw diagrams or imaginary geometrical patterns on the charts or apply arbitrary rules, 135, or apply arbitrary rules or systems such as oscillators. Oscillators are indicators that oscillate up and down, and other impractical notions. Such methods are wrong. Mechanical methods with rules based systems, arbitrary rules using oscillators. This is what he has to say about them. Such methods are wrong. They lead only to errors and losses and discouragement. When you study charts, look for the motive behind the action which the chart portrays. Aim to interpret the behavior of the chart, not patterns, not gaps, horns, flags, pennants. You can add to the list triangles as well as head and shoulders, patterns. Okay. Anyway, I think I'm done for the day. Peace.